Martin Turner here. This week we finalise our look at direct and indirect costs by considering absorption and variable costing. We then consider fixed and variable costs and revise Thao Bach's structure of costs. But first of all, we review briefly the 6 conceptions or ways of looking at what learning is. There's our understanding key cost relationships. We'll also look at ratio analysis. And so we're going to look at direct and indirect costs, finish it off by looking at absorption and direct costing. And I'll ask a question on that. And if you're able to answer this question, you will understand the concepts that we've been looking at. If you can't, then you're still thinking through the issues, which is also fine. Then we're going to have a look at how costs change in business. We're going to look at fixed and variable costs, how some costs stay the same regardless of the level of activity, at least over a range of activity. All costs vary eventually, and also variable costs which vary in a fixed relationship to activity levels such as sales or production. Then we're going to look at ratio analysis and do a minute paper. What is learning? Well, we've had a look at 6 ways we can think of learning at the beginning of the unit. And one of the things we emphasised here is we've got to learn how to learn. And the idea is that we'll be lifelong learners. People who are like that know so much when they get older. Some of my mates know so much about certain things, and others don't know too much about too much. And so lifelong learning, both professionally and in the rest of your life. So we can see learning, as we saw, a quantitative increase in knowledge. That's the most simplistic one. We can also think of it as memorising and reproducing, for example, in assessments. These just build up, so each one includes the one before. Then it can also include the acquisition of facts and methods. That's where we're applying what we learn, say, in the real world, such as at work, or you might be at home or in your general life. But learning can be much more than those. And most university students, including those at Harvard, that's all they experience, really, that type of learning. Probably just a quantitative increase in knowledge. And they can't even remember it. They certainly don't understand it. But we can move into understanding, the abstraction of meaning. That's in the classroom. We can just be thinking to ourselves, what does this mean? And a number of people are experiencing that in learning. And particularly when they're doing the readings, they try to understand, and you can see it in silence. But we can take it a lot further than that. If an interpretive process aimed at understanding reality, that's where we're understanding it for ourselves, and it's changing the way we view some aspects of the world. Those Harvard students that we saw, they could have changed the way they viewed the sun coming in. Like we have on our bedrooms, we have the sun coming in from the north during winter, because the angle of the sun's changing. And that's what causes the seasons, because of the tilt of the earth as it goes around the sun. So we can start to change the way we view business. We can start to change the way we view when we're going shopping, how we're sort of viewing different things that are happening in the store, whatever it is. And learning can be quite a bit more than that too. As we change the way we view the world, we change as a person. Studying accounting can change your lives. Studying, and that's what university is about. And so university educated people are able to think for themselves, solve problems, express opinions with reasons, and be open to listening to other people. The acquisition of knowledge via facts, new experience. Over 45% of people said that's what they think learning is in our unit. Around 5% said it also includes memorization, reading information, and being able to retain it. Taking in and retaining information for future use, around 35%. So you can see that covers pretty well everyone at the beginning of the unit. Gaining a deep understanding of a concept, so around 12% were thinking of that. So there are people who are trying to understand material for themselves, probably quite a bit more than that now. And we had I think one or two people, shapes the way we see the world and growing and changing as an individual. So there are a few people doing this. And so the idea is we just wanted you to be able to conceive and think about that there's more to learning than just the knowledge acquisition, passive learning, turning up to lectures, reproducing information in exams, and then forgetting about it. There's a lot more to learning than that. That's part of learning, but learning includes so much more. And that's on offer at university. It's on offer in all your units. Now, Thao Bach, here's somebody who was seeking to understand the cost relationships. This was her chart from the reading. And we've been looking at product costs and direct and indirect costs. So we're going to wrap up that discussion by looking at absorption costing and variable costing. This is where she put them. What is the difference between absorption and variable costing? I'll just give you 30 seconds. Just write down, you may have no idea, just write down what you can think. What's absorption costing, what's variable costing? How are they different? First response, not sure, Martin. Perfectly fine. We're going to talk about in a minute. Every one of your listed companies were using absorption costing in valuing their inventory, but they may have been using variable costing in their management accounts as well. Please tell us, Martin. One takes in the costs, the other doesn't. No, they both take in costs. Absorption costing involves attaching both direct and indirect costs to each product. Variable cost attaches only variable costs to products. This person may have looked at the next slide or the materials, or they may know it, but that's right. Variable costs change depending on the output, but absorption doesn't. Well, that's not quite true. Absorption costing, direct and indirect costs, a lot of the direct costs, for example, will be variable. Not all of them, but many typically. Some of the indirect costs can be variable as well. There'll certainly be some variable costs within absorption costing, and so they will vary with output. Absorption cost is the expense of all costs, where variable costs are direct costs to certain things. So that's not right, is it? Variable costing isn't direct costs, it's about variable costs. Variable costs are different to direct costs. Totally different concept. We'll be looking at that today. Absorption costs, that's the direct and indirect costs. That's basically what we've been talking about yesterday when we looked at various product costings. One takes in the overhead cost and the other one doesn't. Well, that's also not true. Fixed variable costs, some overheads, if it's indirect costs, we need to be a bit more precise in the use of the word here because it could also cover period costs, which we're not looking at. Indirect costs, some of them can be variable. Fixed costs are not the same as indirect costs. They're totally different concepts. We'll be talking about that today. One takes in the overhead cost and the other one doesn't. That's not right. Absorption cost involves attaching both direct and indirect costs. Variable costs attaches only variable costs to products, which is correct. Absorption costing, also called full costing, that's because we're putting in both direct and indirect costs. It measures both direct and indirect costs, and variable excludes the fixed. Overhead versus variable costs, I don't know. Material costs absorbed in the cost of making the products. That's fine. That's fine. Good to have a go at it because that's all part of learning, isn't it? Now, what it is, absorption costing is both direct and indirect costs. You see, Thao Bach had that right there. See how she got absorption costing there? That's where we're allocating both direct and indirect costs to our products. It's required under the accounting standards for general purpose reports that they do that. She's got variable costing over here, which is using only variable costs to value our inventory. So you may get the opportunity, somebody may come in and say they want to buy some of your product. They've got a special order and they want to pay $100 each. Your product cost might be 120, but your variable cost might be 50. So you could value it, if you valued it variable costing at 50, you say, well, I've got some spare capacity. They want to pay me 100. That'll help cover some of my fixed costs and make a profit out of it on variable costs. But if you did it on absorption costing, you'd bid 120 and you'd say, no, I'd make a loss. So variable costing approach has a role in management accounting and is used sometimes. But let's have a look at this question. There are two, and you can discuss this and come up with a joint answer on the different locations. I'll give you a few minutes. There are two identical firms, B1 and B2. They're identical. One firm, B1, uses absorption costing to value its products and thus its inventory. The other firm, B2, uses variable costing. The inventory levels of both firms increased significantly during the year by exactly the same amount. Although the economic and business realities of each firm are identical, they are identical. In every respect, one firm achieves a significantly higher profit than the other during the year. Which firm achieves the higher profit, B1 or B2, and why? All right, you can chat to each other and come up with an answer, B1 or B2, and why. I'll give you a couple of minutes on this. Two firms, identical. You can talk to each other. You can ask. How could it be that two firms that are identical could have significantly different profits, but the only difference is how they value inventory, whether they do absorption or variable costing? How could that be? And which one is more profitable? You see, if you engage in thinking about it, it doesn't really matter whether you get it right or not. This is part of learning. This is called thinking and trying to understand the material for yourself. I could just tell you the answers, which we will, of course, but this process is important for your learning. So give it a go. Oh, did I have a question here? Oh. I didn't put it in the questions. Might do that.
Here, so I've got absorption costing, this one has variable cost, this one has the higher cost of sales. Absorption. So what cost profit? Which one can give me better profit?
All right, I've put up the question onto the slides. So is the answer B1 or B2? You can do it in groups. Not much happening in Rockhampton, people just sitting around. But this is your chance to think about it. This will help you cement what we've been learning. Trust me, understanding cost accounting is basic, and you need to understand these things if you want it. So, when people have come up with an answer, you come up with either B1 or B2. You can just guess if you want to, but give a reason why. B1 or B2. Well, B1, someone says B1, someone says B2. Got one each at the moment. B2, got 2 to B2 and 1 for B1. Early voting. B3, we've got a B3. But give a reason why. Because, you know, just a 50-50 if you're just guessing. Again, you know, it doesn't matter if you get it wrong. It's like some people got it wrong, what they were talking about absorption costing. It doesn't matter. You often learn more when you get it wrong and you think about it some more. Not an exam. An exam, you need to get it right. But here, well, we've got a lot of B2s. B2, absorption costs are higher expenses which give less profit. B1 would have more economic profit because it would be using the total costs involved with the products and therefore using a more effective method than to use the price of their product. B1 because they're using all costs. B2 as absorption cost has higher costings. B1 but not sure why. B2 because it uses variable costing which only accounts for direct costs. 10 more seconds, then we'll have a look at what is the answer. It's a bit of a spread, but B2 is by far the most popular. B3 is the least popular, being not an option, and there are a few who said B1. Most people have said B2 because, those who gave a reason, is because they said the inventory will have less costs in it, putting the costs. But both businesses have exactly the same expenses and costs. It's identical. Absorption costing will generally, for most businesses, direct and indirect costs will be more than variable costs. There can be exceptions why that's not the same case. But they typically, direct and indirect costs in almost all cases will be more than your variable costs. So with A1, and the answer is B1, absorption costing, because the inventory is growing through the year. That company is putting more of its costs into its inventory. What happens to it when it puts it into its inventory? It goes as an asset, not an expense. So whereas B2 is putting its variable costs into its inventory, so less costs. So where are the costs going? The rest of them that aren't going into the product. What do we call that? Anybody can throw that in. In Rocky or in Mackay or even in Townsville, Cairns, Sydney. What happens if the costs aren't going into the product? What's the other type of cost that we have in Thao Bach's chart? So product costs. B1 is putting more here than B2. So where else can the costs go if they don't go into the product? Into period costs. And what are they treated as each year? As an expense. So A1 has less expenses than B2 because it's put more of its cost into its inventory, which is growing through the year. And so B2 is got more expenses in the year than B1. Revenue less expenses equals profit. So by having more expenses, that's because it's got more in period costs, less into product costs, with inventory rising, then B2's profit will be less than B1's profit. If you understand that, you understand what we've been looking at over the last 2 weeks. If you don't understand it, you should have a look at these concepts. The motivation is a key part of learning, of course, so you've got to think that you want to know stuff. And a certain proportion of people are like that. But if you're studying accounting, if you're doing an accounting degree, you need to know this. This is sort of basic stuff that we're going to build on in management accounting. If you aren't going to do accounting, you need to know this too. This is going to come up a lot in businesses. And people who don't know anything about accounting don't know any of this stuff. And then here's the second. There's that. Given that different accounting treatments can result in different profit figures for our firms, B1 and B2, even though the underlying economic and business realities of each firm are exactly the same. These two businesses are identical in terms of what's really going on. What does this say about the idea of profit? Is a firm's profit the profit? Why or why not? Is profit something real, or is it simply a construct, something we make up based on a number of ideas and concepts in accounting? What does your answer to the last question suggest to you is the role of accounting in business? Indeed, does it even have a role? This is one of the questions in the reading. People who know nothing about accounting think the profit's the profit. Well, the profit could be anything. We're given a lot of choices in accounting treatments, and there are a lot of judgments. There are judgments between whether you put something in period costs and product costs. Regardless, you have to use absorption costing in the accounts, but even with that, you can put some costs into period if you want it, and not into product. And so there's judgments around all that. So the profit can be anything in many ways. So understanding how accounting treatments work and being able to interrogate the numbers, you can use the accounting to connect to what's going on in the business. This is why nearly half of the CEOs of listed companies in Australia have accounting backgrounds, and why nearly half of the directors, probably 40% anyway, you have a look in your own companies, you've got these accountants in the boards everywhere. Not engineers, not IT people, not marketing people. You've got a few lawyers floating around. Accountants, this is why. Businesses are run by numbers. If you don't know what the numbers are saying, if you don't understand these concepts of how it's put together, you're gone in terms of that. So you need some people who do know that. These are very fundamental things. If you don't learn them at university, you can go through your career not knowing these things. And so, anyway, that's a little test for those who've done it, if you're able to figure out why B1 has higher profit than B2, then you understand all the things we've been talking about over this last 2 weeks, over last week particularly. So, Thao Bach, this was her view of the cost of the firm. But, she left out fixed and variable costs, didn't she? She didn't put them, she had variable costing floating around with direct costs, which isn't correct actually, but we'll talk about that later. But she left out fixed costs and variable costs. So, first of all, what are fixed costs? Just write down quickly, what do you think fixed costs are? Fixed costs are costs that can't be changed or avoided. Well, it's not true, is it? You can close down factories, you can do all sorts of things with fixed costs, you can certainly manage your fixed costs. They can be changed. Fixed costs will change with inflation. Everything seems to go up every year. Fixed costs will go up over time. So they can be changed. It's true they can't be, I know what they're getting at. You can't, in the short run, it's hard to close a factory or something like that. So over a period, that's true. But it's not what, I shouldn't be too hard on that. We'll get to that in a minute. Are you thinking what I'm thinking, B1? I think I am B2. That's right. Are you thinking that, B1? Is banana in pajamas still a thing? Don't change with changes in sales or production levels. That's right. This is the key thing. Fixed costs stay the same regardless of whether you increase or decrease your sales or production levels. It's always within a range, though. You might have an aeroplane. Man, do these airplanes cost money? Those A380s are mighty expensive. So that costs you $300 million to buy this thing. The leasing costs kill you. They're fixed regardless of whether you've got anyone flying in the plane or not. Fixed costs. There's a lot of fixed costs. You've got the staff. You've got the airport charges, all this stuff. The variable costs are quite small. It's the food. You feed them. The cost of ticketing. It's the extra weight in the plane of the person. The extra fuel cost, which isn't that huge. So they're mainly fixed costs. They don't change regardless of how many people you have in the plane. But what happens is your demand might keep increasing, and you need to buy another plane. So suddenly your costs of planes, the fixed costs increase. They tend to step up. So over a certain range, the fixed costs will stay the same, but over a wider range, they will also change with levels of activity. So fixed costs remain the same regardless. It's not just over a long period of time. Period of time is irrelevant. Fixed costs change over time. I think, like petrol, the petrol costs might change over time. All sorts of costs can change due to inflation and other things. but it's whether they change with levels of activity. If we're going to incur, sort of like the rent of a shop, we're going to incur it regardless of what our sales are this week. That's the key thing with fixed costs. There's a lot of misconceptions about fixed costs. Go down the street, basically people will tell you they don't change over time. Well, they do. What they don't do is they don't change over different levels of activity, such as sales or production. And some businesses, like airlines, have a lot of fixed costs, and other businesses have much lower. Costs that never change, you see? Not true. But what it is they don't change over different levels of activity. Costs that cannot be moved. Fixed costs are the costs of producing zero outputs. They are the costs, which is quite a nice way of putting it, they are the costs that do not change based on the level of output. That is the thing to get in your mind. Level of activity. It could be sales, production, whatever. Costs that are associated with the product or service involved, e.g. venue hire, or no, there'll be variable and fixed costs involved with products or services. Pay the same amount regardless of output. That's right. So people are getting the idea of that. So they don't change with changes in sales or production levels. It's always within a range. That's what fixed costs are. What are variable costs? Just quickly write down your idea. What do you think variable costs are? They do change with changes in sales or production levels. Costs that change in relation to how much output is produced. A cost that varies with the level of output. Variable costs do not change over time, or they might, because of inflation, but they change over different levels of activity, the opposite of fixed costs. They increase as activity increases. That's right, they change in a fixed relationship to activities. So it might cost you $1 to ticket a passenger in an airplane every time. So it'll be $1 every passenger, sort of average it out a little bit. So variable costs change in a fixed relationship to output. They change with the changes in levels of sales or production. Variable costs. So what are break-even points? That was the other thing we were reading. What are break-even points? A lot of people from the reading, they remember the band example. My son was a teenager. It's quite an old example now. The idea of giving illustrations with the concepts is to give you a hook. So if you come across break-even points, you might think of the example. That was the band example. And then if you can then link that to the key concepts around break-even points, you've got something. You can get back to it. Some people do it with Kinder surprises and the idea of viewing a firm as having separate operating and financial activities, and they're interested in the operating activities, which is the toy inside. These illustrations can help you connect and remember the concepts. The point where all costs are covered by revenue but no profit is made. That's right, where costs equal revenue. Level of sales or production, which is good. It's not just the point. It's the level of activity where revenue is equal to cost. That's the definition. When you split 50-50, I don't know what that means. The sales amount where total profit is zero. When the profit and loss are equal. When sales are equal to costs. You can see that my son and his band, when they were 16, they were very interested in break-even points because they had no money. Making a loss was not going to be a good outcome. Everything's still working all right in the other locations? So that's a very powerful idea. Is that all right? That was one of my 2 contributions to my son in his band on the finances. He's found that quite useful in different areas. So it's the level of sales or production, that's the level of activity, level of sales or production where revenue equals costs. It's a very important thing to get a handle on in our businesses, because if you can get your activity above the break even, you make money. If you get your level of activity below that, you lose money. And generally in business, when you make money, you're happy, and when you lose money, you're unhappy. So break even is that point where, and in terms of assessing the risks in a business, in terms of your exposure to sales or production levels, and its impact on your bottom line, break-even point is a great thing to have in mind. And so my son found it very helpful when he's planning gigs as a 16-year-old, because he could say to himself, he negotiated a certain fixed cost to hire the venue and a variable cost where they had to pay so much per ticket that was sold. But he could figure out how many people he needed at the venue to break even. So he might need 93 people at this venue to break even. So he can say to himself, am I able to get 93 people to come to this? Well, he'd done a number of gigs at a free venue. Well, it was a free venue the council had up the road, and he knew he could get 150 or more into theirs. So he thought, yes, 93 is good. The venue took 250 people or something. And so that helped him. Then he could decide whether he'd spend a little bit of money on posters and advertising, because then he could see that brings your break even up to, say, 100 or something, and he could sort of think it like that. So that's why break even point is an important concept. What is the contribution margin? What is the contribution margin? The profit left after revenue is taken from variable costs. So saying revenue less, or sales less variable costs. Oh, that's the next person saying. Sales less variable cost is a contribution margin. Sales less variable cost, sales less contribution margin is selling price per unit minus the variable cost per unit. So we can look at contribution margin overall, or we can look at it per unit. So if we look at it overall, it's our revenue less sales, perhaps for a product range or for the whole company. Or we can look at it, contribution margin per unit is the revenue per unit. So my son may have sold his tickets for $5 or whatever it was in those days at the gig, and he can figure out his contribution margin. The variable costs might have been $1. That's may have been what he had to pay the venue. So his variable cost was $4. His contribution margin was $4. So everybody who came along contributed $4 to covering his fixed costs, which might have been $200 or something, or well, whatever it was. And so he knew that's what the contribution margin is. It can be per unit or it can be in total. It's often convenient to think of it per unit. My son, who's a musician, he knows all this stuff. He's learned about this. He hasn't done accounting. He's just had a couple of quick, but he could see the practical use of it. So contribution margin, this is possibly the single most important thing you could learn in this unit. If you're going to remember anything, remember this. Contribution margin equals sales less variable costs. If you come out of a subject not remembering anything a few months later or a year later, what good was that? At least remember, contribution margin equals sales less variable costs. Very important concept. Will come up a lot. There are various ways of measuring contribution margin, but we're looking at sort of the basic concept. Contribution margin, what does it tell you? I just said it's the most important thing you could learn in this unit, potentially. What does it tell you? Why is it so useful? CM, oh look, they're using acronyms already. CM, you'll make such a good accountant, is used to pay fixed costs and other expenses. That's right, we're going to use it to cover our fixed costs and also make a profit. The contribution margin tells you the amount of each dollar of sales that contributes to covering a firm's fixed costs and contributing to profits. That's very good. It sounds straight out of the textbook, but that's good. The amount, and that's contribution margin per unit. Or could be overall too, actually, the way that's read. That's fine. The amount each dollar of sales contributes to covering a firm's fixed costs and contributing to profits. To tell you the costs, that it equals sales less variable costs, contribution margin per unit. That's right. So if you've got a high contribution margin, which my son actually had with his early gigs, because the variable cost component was quite small at first, it might be $1, you have to pay per ticket, and he gets $5, so it's $4, like 80%. Well, if he can get a few more people in, that's really valuable. But also, if people don't turn up, that's also a bit of a problem. So he had quite a bit of risk in running these venues, given he had no money. But then what happened when he did it the first time, this was at the Indigo Bar in Cuba Street in Wellington. now called the San Francisco Bathhouse, I think. When they did that, the owner realised that Mark and his band could bring in like 150 people or more. And they sold soft drinks and stuff like that. And it was out of, it was early on the Sunday. I can't remember the time, but it was before, it's like 5:30 or something. So they were making some money at a time when their venue wouldn't really have people much. So when he negotiated again, he could negotiate much less fixed cost. He didn't have to pay $200, say he had to pay $100, because they didn't feel there was a risk that they wouldn't get the people in. So his fixed costs went down, and so his break-even went down. I don't know, the break-even might have gone to 45 people. So his risk of running the venue, that venue was so much less, because he was confident he could get like 150 people. So even if it turns out to be a lot less for some reason, the risks of losing money are much less. And the contribution margin tells you how much, how important it is to get those extra customers. Now with, on an airline, the contribution margin is almost the entire ticket price, because the variable cost of putting an extra person on the plane is next to nothing. But man, if they got fixed costs, like you wouldn't believe. So you might pay $1,000 for a ticket, but man, the variable costs are quite low. And, they don't even print out the boarding passes half the time now, so the variable costs are minuscule. Say they're $10 or $20, whatever they are. So there's a huge risk. So to get these extra passengers in, particularly at the last minute, fill up the back row, this can really make a difference to your profitability. If your contribution margin is very small, say you're selling something for $100, it's costing you 99. You're making $1. So the variable costs are 99, and you're making $1 contribution margin for each time. Then whether your sales vary a bit won't have a huge impact on your total. So what is contribution margin? Contribution margin equals sales less variable costs. What does it tell you? Well, it tells you the amount of each dollar of sales contributes to covering a firm's fixed costs and contributing to profits. This is a very useful thing to know in business, and it can be the contribution margin per unit. Think about it. That's in the assignment, so you'll be able to work on that. Now, this is Thao Bach's view of the cost in a firm. This is how she thought about it when she studied this back in 2007, 2008, actually. But she got it wrong a bit, All the costs of firm are all product or period costs, but there's also fixed and variable costs, and she left them out. So the cost of the firm can be looked at as product or period, but they can also be looked at, those very same costs, as variable or fixed. So some variable costs might be product costs, some variable costs might be period costs, and some fixed costs might be product costs, some fixed costs might be period costs, but all the costs will be either variable or fixed. And the variable costing approach, which is where we only allocate variable costs to products, comes under variable costs. It does not come under direct costs. Variable costs and direct costs are a completely different concept. People are pretty clear on what direct costs are in the readings. Direct costs are the Homer Simpson costs. They're the costs that are obviously part of the cost of that product. So printing off the boarding pass is clearly a cost of having a passenger on a plane. Everybody can see that. But the indirect costs, so that's what direct costs are. They're very clearly connected to products. Variable costs vary with the level of output or activity, completely different concept. A lot of variable costs can be quite clearly connected to a product, but they can also not be. And so they're different concepts, totally different concepts. I also view all this differently to Thao Bach, actually, but this is Thao Bach's revised view of costs in a firm, and a good way of looking at it from a first-year perspective. Now, we're also going to look at ratio analysis, and you'll be coming into that into the assignment, and you'll be able to link your various numbers into the next worksheet, and you do a little formula. So you're generally linking two numbers together. A ratio is the relationship between two items. There are often items in a firm's financial statements, but they can be outside the firm's financial statements, like a share price or other items out there, but usually in the firm's financial statements. Ratios is a very powerful way of looking at a business. So what could these relationships tell us? And why can they tell us something that we mightn't otherwise be able to see? Let's have a look at profitability. It's one area that we're interested in. If we're an equity investor in a firm, we are interested in profitability. And for example, we can look at profit margins, profit to sales, the relationship of how much profit we're making to sales. For example, your business might make $100 million profit, and my business, let's say your business makes $350 million profit, and my business, Ramen Healthcare, also makes $350 million profit. But if your business is making $350 million profit, has sales of $3.5 billion, then your profit margin is just 1%. So you're making 1% profit on each dollar of sales. But my $350 million, that might be on $350 million of sales, so I'm making 10% profit margin. Would you rather make 1% profit margin or 10% profit margin? And why do we care? So the relationship between profit and sales is something we're often interested in. If we're just making 1% profit margins, like airlines make pretty thin margins, well, it only takes a little bit of change in price or costs, and your profit margin's gone. Man, it's risky. But if you're making if you've got a decent profit margin or a larger profit margin, there's a lot less risk of changes in revenue and costs. So we often look at that, and so just the absolute figure for profits may not tell you as much as looking at it in relationship to some other items such as profit margin. We also are going to look at efficiency, sales to assets, asset turnover, we're calling it ATO. The relationship of sales to assets is efficiency. Most people know about profitability and profit margins. Most people know about that. But a lot of people don't focus in businesses, don't focus on efficiency, which is equally important. It's how much sales you can generate from your assets. This might be important to generating wealth for yourself and for equity owners. So typically businesses do around 2 times. Your sales are 2 times your net assets, net operating assets. But some businesses do 3 or 4. Others, like Ramen's, only does 0.35 or 0.25. It has very low asset turnover. But your efficiency, and so, for example, when we, in private equity, when I was in private equity numbers of years, when we're looking at businesses to buy, if we can find some assets that aren't being utilised, like you might have a factory with some land next door that's sort of there for expansion or something, but it's not generating any sales, is it? Man, we could sell that land, and then we'll reduce the amount that we're capital employed in the business and we'll increase the return we're getting out of that business. So from time to time, you can re-engineer businesses, and they do it occasionally, to be more efficient. Now, if you go to the supermarket, they might make 3 cents profit for every dollar of sales. You buy something for $1, they're making 3 cents profit. If you go and buy a luxury car, they might be making 15, and you buy it for $100,000, they might be making 15 cents profit. $15,000 for every 15 cents for every dollar of sales. What would you prefer? 3 cents profit margin or 15? Well, most of us would prefer 15, to 3. But there's more to it than that. If you go to a supermarket, people queue up to give you money. They're queuing up in the aisles. They do self-service. Most of them are paying for it. They do self-service. You've got these queues. You go to a luxury car dealer, there's nobody there. You walk in and it's all very... They don't sell the cars every 2 seconds. They just sell on them occasionally in a week. But the supermarket, man, they're going through the sales. And they can go through 65 billion of sales or whatever, 60 billion of sales. They're just churning through it. So the profit margin, there's a little bit more to it than just the profit margin. And we're going to be looking at return on net operating assets. This is the ratio of a firm's earnings to how much it has invested in its operating activities, its business, to make those earnings. The way to get rich is to have a high return on net operating assets, a high return on capital employed. You only got so much capital. If you can put a little bit of capital in it and it can earn, like 20%, or Ramen's was earning 30, 40, 50% for a while, if you can earn that, you'll get rich. If you can do it consistently, you'll get rich. Ramen Healthcare, it floated at 27 cents. I think last time I looked at it, it's 12 bucks. It's paying over 20 cents a year dividends, almost giving you your original investment back in dividends every year. It's done over 40 times. So if you put $25,000 in when you invest at the float, it's worth over $1 million today, over 20 years. You get rich. This is how you get rich. Return on net operating assets employed. It's not just profit margin, but it's also efficiency. And what it is, if you're running a business of any size, you're looking to maximize the relationship between profit margin and efficiency. To maximize that relationship, quite different to seeking to maximize the profit margin. So in other words, if you're going to change your pricing, say you could bring your pricing down, which might affect your profit margin might come down. But if by doing that, if you're going to increase your sales proportionately more in terms of the relate, you can grow your return on net operating assets. That's how you get rich. Return on net operating assets is the ratio of operating income to net operating assets. Return on net operating assets, OI, divided by NOA. Operating income to net operating assets. You've calculated these figures in your steps 3 and 4, and in the ratios, you'll be calculating ratios by linking to those numbers into the ratios worksheet. So why would we be interested in this ratio? What could this ratio tell us about our business? Ramen Healthcare is still doing about 14% return on net operating assets, but its cost of capital is about 8%, and boy, has it got a lot of net operating assets now. It's one mighty big business, and so it's generating a lot of good economic profit. So Ramen Healthcare provides a return on net operating assets about 14.4% per year. Is that good? Why or why not? These are the sort of questions you can ask yourself. Now, the reason 14.4% is particularly good for Ramen's, it did have a lot higher. It's been coming down for a range of reasons, but I won't go into it here. The economic profit, which is what we'll be looking at when we're doing the ratios as well. Economic profit, this is the profit over and above what you should get to compensate you for the risk. This is value add. It attempts to directly measure the value add. Economic profit equals return on net operating assets minus cost of capital, all times net operating assets. And return on net operating assets equals operating income divided by net operating assets. You'll be calculating economic profit for your firm. And you can see if it's making as much economic profit as Ramen's. So return on net operating assets is how much a business earns on each dollar invested in its business. Ramen Healthcare is earning 14.4% on each dollar invested in its business. It's got billions now. Shareholders only ever invested, I think it's got issued capital of 35 million. That's all they've ever put into it. It's got a market cap of 6 billion now. So, it's just over time, consistently performing over lengthy time can build up real wealth. Now, the cost of capital is the cost of each dollar invested in a business. Capital's not free. The reason capital's not free is you can use it for doing something else. Like my kids put in 2,700. What did they do? They bought 10,000 shares. That's right, $2,700 into Ramen's in 20 years ago. They could have used that for something else. There was a cost to them doing that. It was entire life savings. My daughter was not happy about it. But there's a cost to putting that in. And the cost, as we measured, is the cost of investing in something else of a similar risk. So you could have put your money into Ramen Healthcare, or you could have put your money into some other company. Pumpkin Patch listed at the same time in New Zealand, and a couple of years ago it went completely bust. So you could have put your money in there and you'd have nothing now if you still had the investment. Or you could put it in Ramen's and you've got, over 40 times your money. So the return on net operating assets minus the cost of capital, the cost of the capital times the net operating assets equals economic profit. So we look at the cost of capital there because capital is not free. There's nothing in the accounts of any of our firms that looks at cost of capital. It's not in accounting. But we'll be using 8% unless you have a reason for something else. And the net operating assets is how many dollars are invested in the business. How many dollars have we got invested earning that return on net operating assets? The reason Ramen Healthcare has been able to grow its economic profit while its return on net operating assets has been declining is because the net operating assets has been growing greater than in proportion to its return on net operating assets. Ramen Healthcare makes an economic profit of about $176 million each year. That's $176 million more than it should earn given the risk it takes. It's all right. And you'll be able to calculate the economic profit your firms are earning. In economics, you'll learn that firms can't make economic profit. You've probably already done that. That there's the equilibrium in the market. So you can't make economic profit. Ramen's been doing it for 20 years. And so some businesses are, but have a look to see what your firms are doing. You can see it can take quite a long time to compete away your competitive advantages in markets. But we'll be discussing that as we look at it more once you calculate your numbers, and we'll be tying it into those ideas in economics. Economics comes up in a lot of things. Oh, look at that, I managed to get through that quite well. All right, what we'll do now, we'll have a look at what was the most important thing you learned today. You might say nothing at all. Contribution margin, how to get rich, whatever it is. What was the most important thing you learned today? Contribution margin, sales equals something costs. That's good. You see, while you're learning things, there's always jiggling around it. Variable costs. Remember variable costs. And you need to understand the definition of variable costs. These are the ones that vary in direct proportion to the amount of sales or production activity. Very good thing to remember. The difference between absorption and variable costing. Yeah, that's good. Looked at that. And return on net operating assets. Yeah. There are many different ways to classify costs, and many of them can be classified differently depending on the business and accounts. What a great insight. That is so good. If you can keep with that, you'll be streets ahead of the average person coming out of uni with an accounting degree. That's right, there are judgments, particularly between period and product costs. I'm not sure I've told you this story. Possibly I have, but I'll tell it again. In New Zealand, when I was we're running a private equity business, had various investments. In New Zealand, the economy can just fall off a cliff every so often, and it just goes like that, unexpectedly, because it's exposed to various external pressures. And so that happened one year. And so we're looking at the numbers, and lo and behold, the sales are declining, aren't they? Sales are going down, and the inventory's going up because, you're expecting to sell product and the market disappeared, so your inventory will tend to go up until you've sorted that out. But it was maintaining its profit. The profit was holding up. So some of the directors were saying, man, this is good. You guys are really onto it. They were essentially saying their margins were going up. Well, really, were their margins going up in an economic downturn? I don't think so. I don't think so. So if you know something about accounting, what are you thinking? What questions are you going to ask? Well, so I'm going to, you can ask much more specific questions than why. You can ask, the CFO and the MD, you say, well, are you still you say it in slightly different terms, but I'll put it in these terms for what we've been studying today. Would you have you still been allocating costs the same way between period and product? You know, as you did last year, still doing the same thing? And then they sort of dance around for a little while, and then eventually, yes, they are putting more costs into product costs than period. You see, so they because you see, as we looked at the absorption costing, variable costing example, if you understand that, you see, if you take more of your costs into your product and your inventory is going up, you see, you've got an asset. But if you don't do that, then you've got an expense. So they are holding up their profit by moving costs from period, which will be expense that year, into the asset, into inventory. Yeah, and they're allowed to do that. They're just judgments, you know, they're just making judgments. But of course, when they come to sell that product later on, next year, their margins are going to come down, aren't they? Because they're in at a higher cost. Now, the other board members don't know this, do they? They just accept the numbers. But you see, you've got to be able to interrogate the numbers. And you see, just by understanding something that we just did today, your streets are these questions just come to your mind, don't they? They're obvious things. And you can interrogate and discuss. And accounting numbers are not to just be accepted. The reason accounting and finance people have so much power in organisations is because people don't understand how the numbers are put together. So you put together the numbers and you can get all sorts of decisions on things. Contribution, so that's it. So you can see that understanding some of these things can help. The difference between fixed and variable sales, there are many different ways to classify costs. And yeah, that's that one I was looking at. So that person's got a really valuable insight that can be very useful to you going forward. Let me tell you. There's a lot more to know about accounting, but we're just doing introductory. The importance of the contribution margin. You can see how important that is to have a really good handle on that. And say you've got multiple products. You see, we were looking at my son who's just doing a gig. You know, this is so simple. But if you've got a business with lots of different contribution margins, what's that going to help you with? Well, you can decide where you want to put your effort to sell. You want to sell higher contribution margin products rather than low ones because you're making more money. You know, it's going to be a bigger contribution to your fixed costs. That's what terrified me when I went into, it was St George Rangers years ago, when we bought into that business in the late 80s, an MBO, management buyout, which I mentioned in a previous lecture. And the MD had a major heart attack and was knocked out the day after we bought the business. So I just turn up, walk around the CFO and ask some questions as we're going through the factory about, you know, what the margins are for different products. And he said, we don't know. We don't know what the margin is for this product, that product. And so I said, I remember the feeling very bad because we had a few $1 million invested in this business. I thought, man, this is not going to be good, is it? But I've got to keep asking the questions. How do you price your products? And I remember him today. I can see him so clearly. He said, we charge 10% less than the competition. Man, I thought we're in so much trouble because, number one, what the competition will know their contribution margins. They will focus their marketing effort on the most highest margin products. They'll be the most competitive. We don't know what our contribution margin is, so what is our sales force going to do? They're going to focus on the lower margin products because they're easier to sell. So you see, I just thought we were in so much trouble. It was such a, you know. So contribution margin, importance of contribution margin. Contribution margin goes towards covering the fixed costs. That's very good. And also to profit. We do like to go beyond break even. So once you get beyond break even, you make the contribution margin is contributing to profits, which is how a lot of businesses are running. Everything in the lecture, well, how good is that? It could mean everything or nothing. Fixed costs, variable costs, very important distinction to understand. The reason it's so important is because it tells you how much operating risk is in the business. High fixed costs, low variable costs, you've got much more operating risk. You'll be much more affected by downturns with sales shifting around than a business with high contribution margins. With low contribution margin. The difference between absorption and variable costs, contribution margin is the most important thing to learn in this unit. Contribution margin equals sales less variable costs. The person who's written that has already written it down at least once now, which is good. Write it down 40 times, you'll never forget it. with occasional repetitions. It's so easy. You just write it down. And you could do 8 times a day. People do this. I was a bit like this. People do this. You know, we'd go skiing, you know, when I was at uni, and the ski lifts and stuff, thread bow and stuff get queued up. And I'm writing down, you know, the fundamental accounting equation or something. And someone say, man, what are you doing? We're in the queue. Oh, fundamental accounting. Oh, man, you are so crazy. So you could just, I'm reading the back of the ski lift ticket, looking at in those days, looking at all they're trying to exempt you from all their liabilities if you have an accident. Well, I'd been studying all that in my law degree. I knew they couldn't get away with that. Those don't work. They do try it, but they have no legal effect. They've got to meet their legal obligations. They can't contract them out by putting it on the back of the ski lift ticket. And that helps you with a lot of other issues where the people are trying to contract out. The reason they do that is they're trying to discourage people from suing them. It does work quite a bit. But they're just, you know, they're not of any legal effect. So you see how you can apply and use what you're learning to the real world, and it can change the way you view aspects of the world and change you as a person. But this only works if you're interested in what you study. I picked stuff I was really interested in. I didn't do stuff I wasn't interested in. I didn't do science. I didn't do engineering. I didn't do medicine. I got enough marks to get in medicine. Some of my friends are telling me you should go for that. I said, man, medicine is dreadful. You might as well, if you're doing something you like, then that's a precondition to making the effort to learn it. Fixed costs and variable costs, contribution margin, the amount every dollar of sales contributes to covering our firm's fixed costs and contributing to our profits. And that person's sort of written it in their own words. The difference between absorption cost and variable cost. So we went over that, all these different concepts. It can be quite confusing at first because you've got them all, but Thao Bach had a little way of putting it. Particularly her revised way of putting it is quite good. There are other ways of thinking about it, but that's not a bad way. And you just need some sort of understanding of those concepts, and you can pull it together. Accountants have a lot of freedom to allocate costs. Excellent insight. How to analyse, and of course people are sort of motivated to use those discretions in ways that might help them. It's very, you know, there's a few honest people in the world, and they do exist. I do know. But most people...
Martin, it's Doug here. Do you mind if I just ask a question about the statement around profits?
Yeah.
It's something very dear to my heart, and that's that true and fair view concept. A profit is a profit is a profit, but at the end of the day, you know, we may be getting ahead of ourselves a bit, but the accounting framework, conceptual framework, the desire to get the best possible information to the investors and shareholders is going to have an impact on some of the concepts that we bring to bear in the allocation of costs, is it not?
That's an excellent comment. You see, there are ethics for accountants.
On your duck.
On your duck? Who was that? Is that in Townsville? Is that you guys in Townsville? Man, you're writing some great stuff up there, you guys. As I'm reading the different assignments, really interesting. But yeah, this is a very good point. And it's not something we particularly emphasise in our first term one, but we will be doing it in our second term unit, is that there's ethical obligations around accountants. People say, well, what's the ethics obligations for accountants? I mean, what is it? Well, it is to use your judgments in a way that helps people to connect to what's really going on in the firm. That's that true and fair view idea. So when you're making decisions, you're making decisions to help people to see what's really going on, rather than telling stories that you might want them to hear. I remember one business, it was Eskimo Logistics. It was this business in New Zealand that were sort of rolling up a whole lot of cool stores, these big rooms freezing stuff. And there was a group there, and the CFO was great. And so we were trying to sort of saying, can't we have the accounts look like this? And he's saying, no, you've got to do this because this is what's really going on. And we discussed it with him, but he was right. He was onto it. He wasn't just disconnected. He knew what was going on in the business, and he was able to argue the case as to how that needed to be presented. And so we did do that. We got a lot of respect for him. And then when we sold that business, and we keep buying other businesses, Well, we put him in as a managing director of another business. We were impressed. This guy was onto it, you know. So it's not just making the ethical judgments without really understanding what's going on in the business, because that can be very irritating, accountants doing that. But as an accountant, you need to understand what's really happening in the business, particularly at the more senior levels, and make sure the accounts are connecting people to what's really going on. That's the ethical obligation of accountants, and it's very important in the operation of our capital markets, particularly for listed companies, but for, you know, the larger private companies too. And how many accountants understand that? So some do, but a lot don't. You see, if you come out thinking, most people come out of university thinking whatever they're studying is a game. They start thinking, when they start, they think that there's a black and white answer to everything, and they'll sit in the lecture, write it down, give it out, and that's it. But then they gradually realise that no, there's a lot, and they start to, it's all relative, you know, it all depends, you know. And that's an important part of intellectual development, but a lot of people finish uni like that. So they come out of their accounting, finance, law, everything else, medicine, thinking it's all a game. Our financial markets are full of people like that. They think it's just a game. So if you think accounting's a game, well, you can just make the numbers say whatever you like that suits you, you know, it's a game. But you see, if you make the intellectual development, which you can do at uni, and it's a difficult one, but some people do it, and you go through that relativism stuff, that it's all a game, into having personal commitments based on evidence. I think this for these reasons. And I'm open to discussing it with you. People who are in the top areas of their professions, like architects, they're like this. They might have a view about form versus function. You know, they might think form's more important than function, whatever. They go on and on about these things. And somebody else might have a different view. But they can discuss it. And they can give the reasons why. I have various views on my areas of expertise, and I can give you the reasons why. I've thought about it a lot. But I'm open to hearing. I know people I know have different views. And it's interesting. And you can keep thinking about it. But you have personal, it's a completely different way of thinking that there's a black and white answer to everything. Give me the answer, Martin, and I'll write it down, that's it. And it's different and to ending up just thinking it's a game. Accounting is not a game. And even though a lot of people think it is. And we find that with accountants in various businesses I'm dealing with, they think it's a game. Management too can think it's a game to push forward their thing. Certainly just around the edges, you know. And but ethics, the true and fair view is that the accountant has an obligation, particularly if you're a member of a professional body, that's certainly the case, you sign yourself up, but all accountants have an ethical obligation to ensure that the accounts reflect what's really going on. So the people running that business that I had who were moving some of the period costs into product costs in order to spin a story, that's not what accountants should do. They should tell us what's really going on. And what was really going on was that their profit was going down. Because their sales were going down, their margins were much the same. Their margins hadn't gone up. And they should have shown us that. And I got them to redo the accounts to make sure we'd seen what's really going on. And we didn't want a whole lot of cost in inventory that was going to stuff up our margins in the future anyway. And you've got to get dealing with that inventory and get it down. Because we're interested in return on net operating assets. We don't want a whole lot of inventory sitting around. We want to work the assets. We want to get rich. And so, yeah, that's a really good point. And you can see how it works with that comment about there being so many judgments. That's why there's ethical issues for accountants. Did that answer the question?
Yes, thanks, Martin. That's great to see you share my passion. Thank you.
Yeah. Everybody does who's for real with accounting. But of course, and that's very, very important for the credibility of our markets. And markets that don't have that, there are plenty of them around in developing countries, I just wouldn't invest in them because you can't have any confidence. And you're concerned that, and when we do the capstone unit in accounting at the end of your degree, so for those doing accounting now, this is your beginning, but when you get to the end and you do financial statement analysis, one of the questions we ask ourselves early on is you've got to form some sort of judgment around the accounts as to whether you think they're telling you stories or whether, you know, that are suiting where they're going in the numbers. They will do that in the words and photos that you can see in your annual report. But in terms of the numbers, are they doing that? Are they spinning you stories or to what extent are they telling us what's really going on? So you need to sort of have a sense of judgment about that. and that's good. Alrighty, well, I think we've probably done enough. We've got, what questions still remain unanswered? Why does everyone hate season 8 of Game of Thrones? You see, we always get a few like that. They're completely disconnected to what we're doing. Lots of questions, which is excellent, but you could have just written one of them down. Nothing right now. See, if you're interested in in your subjects that you're studying, you'll keep having more questions, because as you learn something, it just raises more questions. And so you can see how the issue of, oh, they've got all these judgments, raises a question of, boy, what ethics do they have to do? You know, how can we trust? You know, it raises lots more questions. Can you tell me the difference between product costs and period costs? I'm still confused. That's an excellent question. This is fundamental to understanding management accounting. Product costs are those costs that we attach to products. So when we say we spent some money on something, and so we're going to pay cash for it, right? That's an asset, and that's going to be a credit. We're going to drop the cash. But if we attach that cost to a product, it'll go into an asset. So we increase an asset and reduce an asset. Reduce cash, increase inventory. So no effect on our profit. But if we turn it into a period cost straight up, then it will be an expense. So our cash should go down, our asset will go down, that's a credit, but the debit will be an expense. And we know how that debits and credits work because we know the fundamental accounting equation. Assets plus expenses equals equity plus revenue plus liabilities. And the items on the left of the equal sign, if we increase them, it's a debit. Increase them as a credit. So you can follow through the debits and credits for those who are going to study accounting. So you can see that if we treat it as a period cost, it's going to be an expense and it's going to reduce our profit for that period. We look at profit over a period. It might be a month, 6 months, or a year. Let's think of a year. But if we put it into a product cost, then if it's not sold, it'll only become an expense when we sell that piece of inventory, and then we call it cost of goods sold. It's an expense. So the asset turns into expense. In other words, we reduce the asset, which is crediting it, and we debit cost of goods sold, the expense. If that happens in the next period, then at the end of the period, for the inventory will be the items we haven't sold yet, those product costs are in our assets. Those expenses are in our assets. That's why it's an important. Now, you can't have a rule for everything in accounting. There are all sorts of rules, but you can't have a rule for what's a period cost. You can't have a list. It doesn't work like that. There are judgments. If you tried to have a list, then people would be forced to put them in, and that may not be appropriate to your particular business. Every business is so different. There are going to be judgments in how you allocate between period and product costs. And so if you can understand that, and the basic point is that period costs are treated as an expense straight up, if you like, in that period, whereas product costs are treated as an asset at first, as inventory, and only as an expense once they're sold, which could be in the next period. So keep thinking about that. Once it clicks what that difference is, you'll be able to answer questions like that absorption costing, variable costing question, because you'll understand how the costs are going through. Hopefully that helped a little bit. When will be issued step 3 and 4 marks? Well, we've marked most of them actually that have been submitted, so we're still working through. Probably the next couple of days, but of course people are still submitting. So yeah, I think we've got through nearly 60% of everybody, of the people we think are going to submit in total, and that's probably 80% of the ones who've submitted so far. So it's coming. Why is high return on net operating asset important for businesses today? Also, we will be giving feedback, of course, on steps 3 and 4, and for some people you'll need to tidy up your spreadsheets a little bit in your balance sheet, but we'll give you your answer for the restated income statement, so you won't need to do anything for that if you've made an error in that. Why is high R&O important for businesses today? Great question. Warren Buffett is thought of as arguably the most successful investor of our generation, and he started with nothing. And he earned a bit of money, but in terms of his performance track record, he started with about $100,000, started investing it, and he's become one of the richest people in the world, 80 billion or something, over, a long period of time, 50 years. He managed to do that because he earned he's averaged 20% year in, year out on his investments. And the share market does about 10% a year. So he did 20% consistently. A long period of time, he becomes one of the richest people in the world. If he could live to about 300 and he could keep doing it, he would end up owning everything. We'd all be working for Warren Buffett. So return on net operating assets, if you can get a return on 20% of what you invest versus 10%, you'll get seriously rich over time. And Ramen Healthcare has been sort of like that. If you can identify some value investing, if you can find some businesses that have got, you can analyse them and form some judgments around them, you can get rich. And the reason you do that is it's not the profit margin, it's also not the asset turnover either, but it's the relationship between those two that drives the value creation. And if we had unlimited capital, it wouldn't matter, but we have limited capital. So use of Ramen Healthcare, back in mid-99, I was looking to find an investment for the children in New Zealand. They're fairly new. And I wanted them to get some experience as they went through their teens, investing. They'll get plenty of experience in consumption, but I want to invest in. But I wanted to make sure it was a good experience. So I put a lot of effort into making sure I give them a good one, And so you can never be sure, but, I put a lot of effort in it. And so if I put the money in that one, they've got like 120,000 instead of from their 2,700. But if I put it in pumpkin patch, they'd have nothing. So the return on net operating assets is pretty important, isn't it? And it's a key measure of value add. And when you're running a business, you have to make decisions not just on profit margin, but on efficiency and the relationship between the two. So the marketing people will tell you that the customers want 300 different colours, and they want this, they want that, they want the other. But you've got to think to yourself, and it'd be great if the senior marketing people would think about this. Well, if I give them more colours, I've got to have more inventory. I've got to stock all this stuff. I'm going to have more capital employed in the business. And is this going to, how's this going to help me? So you have to think through those arguments. It might be important to position yourself for whatever it is. You might be able to get more margins. You might be able to position yourself. But you have to think through those relationships. And a lot of people fail to do that in business. So that's 10-second recap on ratios. You'll be doing ratios, and what you'll be doing is you'll be linking basically two cells to one cell in the ratios. Most of the numbers will be in the financial statements or the restated financial statements, and it's all described in the spreadsheet. Sometimes you'll have to get some numbers from outside the financial statements, basically the share price. You also may have some difficulty finding the number of shares. It is in your financial statements. It's usually a footnote in the equity. And most people can do that really quickly. You can do it in class. You can do it in our tutorials. And Smart Money will do that. Maria tells me quite a few people in Mackay do this sort of stuff quite a lot. When is the best time to buy Ramen Healthcare stocks, Martin? See, people always want stock tips, don't they? But you see, because we don't want to think for ourselves, we want somebody else to think for them. So I have to tell you, I've used Ramen Healthcare for years. I started doing it when I started teaching the MBA unit, because my youngest son was thinking of selling the shares. And I thought, man, I better keep an eye on this company because I need to tell him whether I think it's a good idea or not. So I said, I'll put it into this unit and get some students to analyse it, and I'll have a good look. And so we did that. And I think the shares were probably $1, I think, at that time. And so I looked at that, and he had like 10,000 shares. That was $10,000. That was like $1 million to him. How old he was like 9 or something. And so I looked at it, then I came back and said, look, I think they might be worth $2 in a few years. And I saw his eyes going up, and he said, you see him working it out, 20,000. So I'll hold on to it. So, and then I realised I need to keep track of this investment. It's getting a bit big, doing some of this. So I've used it in units, other students' financial statement analysis, but I analyse it in quite a lot of detail. I give you some simple parts of that as examples. So that's what I do. And if you can't analyse firms for yourself and make these judgments, it is a bit of a skill, but I've also found people can learn it. But if you can't do that, then you're at the risk of people giving you advice, and that may work out. So people.
Martin, council's about to go.
Okay,
We'll
thank
see
you very
next
much.
week.
Thank you. Everyone's about to go.